going to start. Welcome to chapter 10. Guys, can you believe it? It's chapter 10 already of financial accounting. Those of you that are listening to this on YouTube, feel free to subscribe. I teach this for a class here in Minnesota, Anoka Ramsey, and I am talking about chapter 10 today. So this is dealing with stockholders' equity. Now, guys, we've covered a lot of stockholders' equity, but we're going to add some additional pieces. That's what this whole book has been about. We learn some concepts, and then we just delve deeper into some of these concepts. So we know stockholders' equity has several components. Now, we know about the paid-in capital, and we know about retained earnings. The paid-in capital is the amount from stockholders. The retained earnings are those earnings that have been received by the company since its inception. And so the new component we're going to talk about is treasury stock. Paid-in capital, amount stockholders have invested in the corporation. Retained earnings are the amounts of earnings the corporation's retained. And then treasury stock is when the corporation's own stock has been reacquired by the corporation. So we'll talk about that. So here you see the portion of the stockholders' equity section. You see common stock. You see additional paid-in capital. Then you see retained earnings. And then you see a piece called treasury stock. Now, treasury stock is subtracted from stockholders' equity. And we'll talk about that in a little bit. So what are some advantages and what are some disadvantages of the corporate form of ownership? Now, we know that the corporate form of ownership, they oftentimes, the people who run the company are not those who own the company. So as you see, you have the stockholders who elect the board of directors. And then the board of directors elects a chief executive officer who then hires all the individuals to run the company. Ultimately, the stockholders control the company, but they don't do the day-to-day operations of a company. Okay? Corporations raise money from usually the initial founders of a business, and then they grow and seek money from various types of other venues, angel investors or venture capital firms. Then to go public, they would pursue an initial public offering, which is the first time the corporation issues stock to the general public. So oftentimes when a company is starting, they get money from the initial owners or founders and then their friends and family. Then they reach out and try to get sources from different investors. And then when they need more, that's when they would do an initial public offering. Know that public corporations are regulated by the Securities and Exchange Commission. They're the Walmarts, the Best Buys, the Microsoft, the Apple. Lots of stockholders, and it allows for a lot more investment. Private companies are basically not regulated by the Securities Exchange Commission. There are fewer stockholders, and there is not a public investment. And there are some big private companies out there. Cargill's one of the biggest ones. Coke, which is here in Minnesota, is another really big one. When you are a stockholder, you have the right to vote. And you also have the right to receive dividends. And if a company is dissolving, you have a right to share in the distribution of assets. The biggest advantage of a corporation is its limited liability. So you can't lose any more than you have invested in the company. And its ability to raise capital. One of the biggest disadvantages is the amount of paperwork that can be involved and regulation with corporations. Now, guys, we're going to start here. Which of the following is a primary advantage of forming a corporation? Is it reduced taxes? Is it increased personal liability of the owners? Is it increased ability to raise capital and transfer ownership? Or is it fewer state and federal reporting requirements? Take a minute and let me know. Increased ability to raise capital and transfer ownership. Now, when we issue common stock, we're going to talk about the various pieces of the various journal entries when we deal with stock. No, the company initially at its founding will authorize so many shares. Those shares are either issued or unissued shares. Those issued shares could be outstanding, or they can be repurchased by the company, known as treasury stock. No, authorized stock are those shares that are available to sell. Issued is what's been actually sold that are out in the public, and including treasury stock. But outstanding shares are shares that are held by the investor that do not include treasury stock. The par value of a stock is the legal capital per share of stock that's been assigned when the corporation first is established. It actually means nothing. It has no relationship to what the market bears for that stock. Sometimes people will confuse par value with market value, but it's not. Par value is just what's been assigned per share when the corporation first establishes the stock. Many people really have like 0.001 cent par value. So don't, know that the market value is always going to be extremely higher than what would ever be shown as par value on the stock. In this example, we're going to show how we would record stock from Canadian Falcon that issues 1,000 shares of what we call no par common stock. We would debit our cash and we would credit just flat common stock. But if Canadian Falcon issues 1,000 shares of 1 cent par value common stock for $30 a share, then we're going to do it a little different. So what we would do is debit our cash. We would credit our common stock for $10 and then credit additional paid in capital for $29,990 for the difference. I'm going to give you a minute to look at that. Right? So, sorry, guys. Know that if you were to put it just into common stock when there's no par, or if there's a par value, you put just the par value in common stock and any additional in what we call additional paid in capital. They are both stockholders' equity accounts. We're just going to record it different if we have par versus no par common stock. So guys, when company A issues 20,000 shares of $5 par common stock at $12.50 per share, the entry we would record would be a debit to cash for $250,000. We would credit the common stock for just the par value, 20,000 shares at $5 a share, and then we would credit the additional paid in capital for the difference for the $150,000. Okay. Now, there is another type of stock out there called preferred stock. Preferred stock is kind of a hybrid. It's called stock, but sometimes individuals think that it acts similar to a bond or borrowing money. Usually you don't vote. And basically, the risk to the investor is lower than common stock, but it's not as low as a bond. It's pretty much a safer alternative to common stock, but it can be a hybrid because oftentimes they are guaranteed a fixed dividend. And so it can be sometimes classified as a liability, but for our purposes in this class, we are going to show it as part of the stockholders' equity section. Sometimes preferred stock can be converted to common stock. Oftentimes it can be redeemable. These are features of it. They don't all necessarily have these, but they're features. It can be cumulative, meaning the shares receive priority for future dividends if dividends aren't paid in a given year. So basically, when we're talking about cumulative stock, if this preferred stock is cumulative and a company has not paid dividends in a year, the preferred stock accumulates, the dividends accumulate until the company does pay out dividends. The preferred shareholders are the first ones to receive those dividends in arrears. So in this example, if the company finally in 18 declares a $10,000 dividend, well, then the dividends that the preferred shareholders did not receive in previous years will be paid out. So you see in this example for 2016 and 2017, they received those back dividends, and then they receive them for 2018. Then what's ever left over goes to the common shareholders. When the preferred stock is called non-cumulative, then those dividends that were in arrears just are lost. You don't get them. So in previous years, if they're non-cumulative, the preferred shareholders just don't receive those dividends if in fact the company chooses not to pay out dividends. So then in the year they decide in 18 we're paying dividends, then the preferred shareholders get their allotted 1,000 shares times 8% times the par value, or $2,400. And then the rest goes to the common stockholders. So here you see the section of Canadian Falcon showing par value stock. So it has it separated by the preferred, then the common stock is listed the par value portion, and then the additional paid in capital. Along with that, you see the retained earnings for the total stockholders' equity. So again, preferred stock can have a variety of features. Some times it can be linked with bonds in the liability section of the balance sheet, but for our purposes, we are going to treat it as stockholders' equity. So guys, we're going to start with this exercise. Nathan's Athletic Apparel has 2,000 shares of 5% $100 par value preferred stock the company issued at the beginning of 2017. All remaining shares are common stock. The company was not able to pay dividends in 2017, but plans to pay dividends of $22,000 in 2018. Assuming the preferred stock is cumulative, how much of the $22,000 dividend will be paid to preferred stockholders and how much will be paid to common stockholders in 2018? Then we'll look at if it's non-cumulative. So in 17, they've got preferred stock. So as you see in 17, we would show the 2,000 shares times 5% times the $100 par value. If it's cumulative, we would show the amount received that would be received in 2018 for the arrears of 2017. We would also show the 2018 preferred dividends. And then the remaining would go to the common shareholders, stockholders of $2,000. So the total $22,000 dividend, 20,000 of it would go to preferred shareholders and 2,000 of it would go to the common shareholders. If it's non-cumulative, then any dividends from 2017, they're not going to get. But then in 2018, they'll receive $10,000 by 2,000 shares times 5% times $100 par value. Then the remaining will go to the common shareholders. Any questions on that, guys? So which of the following is a primary advantage of owning preferred stock? Preference over common stockholders in the distribution of assets in the event of dissolution. I don't think I mentioned that, but that is the case. However, oftentimes when a corporation goes bankrupt, there is no additional monies because they're all pretty much going to go to the loans outstanding. Now, this big piece is going to be talking about treasury stock. Oftentimes, corporations purchase or reacquire their own stock. Sometimes they do this to boost the price, or if they have cash available in order to circumvent paying dividends, they'll need to do something with that cash, and sometimes they will purchase treasury stock. And since they're purchasing their own stock, it reduces how many shares are outstanding. So then it ultimately boosts the earnings per share. Oftentimes, in this day and age, employee stock plans are really big. So if they need to reacquire stock in order to satisfy those, they may have to do that. But no, guys, the purchase of treasury stock is different than purchasing an investment in another company. An equity investment is the purchase of stock in another corporation. And in that case, it's an asset, and we treat it as an asset on the books. But treasury stock is repurchasing the corporation's own stock. And when we do that, we record it as a reduction in the stockholders' equity section because it's not an asset. The company can't invest in itself. Assets are when a company invests in another company. So when Canadian Falcon repurchases 100 shares of its own 1 cent par value common stock at $30 a share, the way we record this is a debit to treasury stock for the entire amount and a credit to cash. Okay. The debit to treasury stock is going to reduce stockholders' equity. Treasury stock has a debit balance. You know, stockholders' equity has a credit balance. So this is a contra equity account. So what you'll see here is before the repurchase of the treasury stock, the stockholders' equity was sitting at 100,000. After the treasury stock was purchased, the stockholders' equity section is sitting now at 97,000. Now, Canadian Falcon had purchased treasury stock. Now they're going to take that treasury stock and reissue it to the public. So when Canadian reissues the 100 shares of treasury stock, we remember we bought it for 30, but we're going to reissue it for 35. Then the journal entry will be our debit to cash, our credit to the initial amount we purchased that treasury stock for. And then the difference will either be an additional paid in capital. In this case, we are increasing our additional paid in capital. We want to make sure we zero out the treasury stock, and the offset will be a debit or a credit to additional paid in capital. In this case, the credit increases the stockholders' equity and ultimately shows a gain on the sale of the treasury stock. So again, after it was reissued, we see that the stockholders' equity section now is up to 100,000. Sorry about that, guys. So as you see, after the Treasury stock has been sold to the public, the total stockholders' equity increases. So reissuing Treasury stock, we know we purchased that Treasury stock for 30 bucks. And in our initial example, we reissued it for 35. But let's say we now reissue it just for 25. What do? Well, we debit our cash for our 2,500. We still credit our Treasury stock for the full amount that we purchased it for. But in this case, we've got a loss on the Treasury stock. So we're going to debit additional paid-in capital for the difference. So no, we've got to zero out the Treasury stock, and then we'll do an additional paid-in capital either as a debit or as a credit, depending on if it was a gain or a loss. In this case, we sold it back for 25, which was lower than what we purchased it for 30. Okay. Remember, we include Treasury stock in the stockholders' equity section of the balance sheet as a reduction in stockholders' equity. But when we reissue that Treasury stock, we report the difference between its cost and the cash received as either an increase or a decrease in additional paid-in capital. So guys, let's look at another problem here. Finishing Touches has two classes of stock. One is an 8% $10 par preferred, and then we have a $1 par value common. The following transactions affect stockholders' equity during 2018, its first year of operations. On January 2nd, we issued 100,000 shares of common stock for $35 per share. Then on February 6th, we issued 3,000 shares of 8% preferred stock for 11 bucks per share. So let's just look at those two transactions. The first one, when we issued on January 2nd, 100,000 shares of common stock for $35 per share. Remember, our par value is $1. So we debit our cash for $3,500,000. We credit common stock for just the par value amount, 100,000 times $1. And the difference goes into additional paid-in capital. Then on February 6th, we issued 3,000 shares of 8% preferred stock for 11 bucks a share. We debit our cash for $33,000. we credit the preferred stock at par value only. The 3,000 times $10 was the par value. And then that additional amount, since we sold it for $11, that additional dollar will go into additional paid-in capital. Okay. Now it says on September 10th, we repurchased 11,000 shares of its own common stock for $40 a share. So that's going to be a debit to Treasury stock and a credit to cash for the entire amount. And we have to remember what we purchased it for, $40 a share, because we need to zero that out. Then it says on December 15th, we reissued 5,500 shares of Treasury stock at $45 a share. Remember, we bought it for $40 a share. So we are going to show 5,500 shares at $45 for cash of $247,500. We need to zero out the 5,500 shares at $40 a share for Treasury stock. And that difference, that $5 difference, will be shown as additional paid in capital. It's basically a gain. I'm going to give you a minute to look at this. Treasury stock has, is it A, a normal credit balance? Treasury stock decreases stockholders' equity? Yes, that is the answer. Remember, it's a contra account. So it will decrease the stockholders' equity. Now, we're going to spend this next portion of time talking about how we record dividends and various types of dividends. Earnings retained in the corporation is the retained earnings. When we pay them out as dividends, we offset that against retained earnings. Retained earnings is going to equal net income minus all dividends since the company began. You don't want to see a deficit or a debit balance in retained earnings. So, retained earnings over a 4-year period, if in year 1 there's a loss, we have a debit balance in retained earnings. If the next year there's a $3,000 income, then we end up with a $2,000 credit in retained earnings. The $1,000 debit plus the new $3,000 of net income will give us a $2,000 credit in retained earnings. Then in year 3, our income was $4,000, but we paid out $1,000 in dividends. So we're going to add $3,000 to the previous year for $5,000. And then in year 4, our income was $10,000, but our dividends are $3,000. So that net 10 minus 3 is 7,000 will get added to our balance and retained earnings from year 3 of 5,000. So the 5,000 plus this new 7 gives us our 12,000. Remember, the balance of retained earnings equals all net income minus all dividends to date over the life of a company. Sometimes students incorrectly think that retained earnings represents a cash balance set aside by the company. Remember, the size of retained earnings can differ greatly from the balance in the cash account. Now, cash dividends are those distributions a company provides to its stockholders. Oftentimes, dividends paid by a company really are helpful. It can be an incentive to invest in that company. But not all companies necessarily pay dividends. If you think about it, companies that have growth potential need their cash to expand. So they're less likely to use their cash to pay dividends because they need it for other purposes. There are a couple dates we need to know regarding dividends. There's the declaration date, the date on which the board of directors says, hey, we're going to pay a cash dividend. The record date is the specific date on which the company determines who's going to receive those dividends. So those people who own stock on that record date are the ones that will get the dividends. And then the payment date is the date the actual cash is paid out. So know that in this example, there are 3 different dates we have to look at. On December 4th, the board of directors declared a dividend of 11 cents per share. Payable on December 28th to shareholders of record as of December 19th. So the declaration date is December 4th. The record date is those shareholders that had stock on December 19th. And the payment date is December 28th. So let's show how we're going to prepare these journal entries. On March 15th, Canadian Falcon declares a 25-cent per share dividend on its 2,000 outstanding shares. On that declaration date, we record our dividends and our payable. Okay. The dividends declared by Falcon is paid on April 15th. It's at that time we debit our payable and credit our cash. For the date of record, there's no journal entry that we need to handle. The declaration of cash dividends decreases retained earnings and increases a dividend payable. The payment of cash dividends decreases our dividends payable and decreases cash. The net effect then is a reduction to both retained earnings and to cash. So here we're going to look at good old Italian stallion. Here are the various transactions. On February 1st, we issue 6,000 shares of no par common stock for $16 per share. We'll debit our cash and we'll credit all to common stock since it's no par common stock. Okay. Then on May 15th, we issue 700 shares of $10 par value preferred stock for $13 per share. Again, this has a par value, so we'll debit our cash. We'll credit the preferred stock up to par value, and the extra goes into additional paid in capital. Okay, then it says on October 1st, we declare a cash dividend of $1.25 per share to all stockholders of records. It's at that time we're going to debit our dividends, 6,700 shares at $1.25, and we credit our dividends payable. October 15th is the date of record. There is no journal entry to show anything on the date of record. We know the date of record are those stockholders who own stock on this date are the ones that get the dividends. Then on October 31st, we pay the dividends. It's at that time we will debit our dividends payable, and then we credit our cash. Okay. On which date would a company record a debit to dividends and a credit to dividends payable? It's always at the date of declaration. Now we're going to talk about stock dividends and stock splits. This is another way that management will pay out dividends. Stock dividends are additional shares of a company's own stock given to shareholders as dividends. But a stock split's a large stock dividend that includes a reduction in the par or stated value per share. So if you've got a 10% stock dividend and you own 100 shares, that means you'll get 10 additional shares. If you own 100 shares and it's a 20% stock dividend, you'll get 20 more shares. If it's 100% stock dividend, you get 100 shares. The top two are small stock dividends. The other one could be called a large stock dividend, or it could be a stock split. Stock splits, or for that matter, large stock dividends, reduces the par value per share and increases the number of shares outstanding. There's no transaction you need to do. Large stock dividends record a decrease in retained earnings and an increase in common stock and are recorded at par value. So depending on how a company wants to code it, if it's a stock split, we don't do anything with it. But if it's a large stock dividend, we'll always decrease our retained earnings and then increase our common stock. So our stockholders' equity section is going to stay the same. It's just going out of retained earnings into common stock. So as you see here, when there's a stock split, the only thing that changes is the par value per share. When there's a stock dividend, ultimately, the total stockholders' equity isn't going to change, nor will the par value. But common stock will increase and retained earnings will decrease. It's kind of like a piece of pizza. When you have a stock dividend, you only have one pizza. You can make more slices skinnier and give everyone more, but it's ultimately still the same. You can make this pizza 4 shares of pizza, 4 pieces of pizza, or you could make it 16 pieces of pizza. You're ultimately getting the same amount of pizza. You can just tackle it and present it in a different way. So guys, on September 1st, the Board of Directors of Colorado Outfitters declares a stock dividend on its $10,000, $1 par common shares. The market price of the common stock is $30 on this date. And then we're going to do it in 3 different ways: a stock dividend, 10% dividend, 100% stock dividend, or a 2-for-1 stock split. If we record the small 10% dividend, we'll take our stock dividends, 10,000 times 10% times 30. We credit our common stock, and we credit additional paid in capital. So that stock dividend portion will be against retained earnings. So our retained earnings will decrease, but our common stock section will increase. If we record the stock dividend, assuming 100% stock dividend, we'll just debit our stock dividends, credit our common stock. And then if it's a 2-for-1 stock split, there's no entry that we would record. If a company has 1,000 shares of $20 par stock outstanding and issues a 2-for-1 split, how many shares are outstanding after the split? We would then have 2,000 shares. So remember, anything to do with the balance sheet is a snapshot. It's a picture in time, and it can change immediately. The statement of stockholders' equity shows all the changes that have happened in the various sections of the account over the year. The stockholders' equity section just shows in a point in time. So here you see for Canadian Falcon, everything shown in their stockholders' equity section: their preferred stock, their common stock, their retained earnings, and they don't have any treasury stock here. Now, the statement of changes in stockholders' equity, we know the balances will end up in the balance sheet. So the balance as of December 31st is what we see here. But the statement of stockholders' equity gives us all the detail that happened during the period. So it shows us when we issued common stock, when we issued preferred stock, when we repurchased treasury stock and sold it, and the cash dividends and the 100% stock dividend. It shows us everything to do with the stockholders' equity section, the detail. So guys, I'm going to let you answer this. There's 7 of us, or 7 of you. How does the stockholders' equity section of the balance sheet differ from the statement of stockholders' equity? A, the stockholders' equity section shows the balances at a point in time, and the statement of stockholders' equity shows activity over time. B, the stockholders' equity section shows the activity over time, and the statement of stockholders' equity shows the balances at a point in time? C, there are no differences? Or D, the stockholders' equity section is more detailed? What do you think? Two people are missing. Where are you? Okay. You got it. So United Apparel has the following balances in its stockholders' equity section on December 31st, 2018. It tells us our treasury stock is at 850,000, common stock 600,000, preferred stock 3,600,000, retained earnings 2,200,000, and additional paid-in capital 8,800,000. Our job is to prepare the stockholders' equity section of the balance sheet. So we see here, we start with our preferred stock. We then do our common stock at par, additional paid-in capital. For our total paid-in capital to be 13 million. Our retained earnings is 2,200,000. And we subtract our treasury stock to give us our stockholders' equity of 14,350,000. Okay. Now you've got some various ratios I'm going to let you deal with on your own. Dividend yield and return on equity you hear a lot about. I'm going to let you do that on your own. Are there any questions you have before I end? Well, guys, I am going to end this. Bless you all. Have a good week.